Hello and welcome to this special interview on money control, where we are discussing 30 years since the historic reforms of 1991 that really liberalized India. We're in conversation with veteran banker KV Kamath, one of the tallest leaders of India Inc. Thank you very much, Mr. Kamath, for talking to us on money control. Let me start by asking you, you had a very interesting career trajectory. You left ICICI in 1988 to join ADB in Manila. You came back in 1996 to ICICI to head up the bank just when the reforms had been introduced and they were taking off a few years later. What was it like? Because before reforms, 99% of the banks were controlled by the government of India. So, how did this really change the banking sector?
Thank you. So mid 1990s, when I came back, one liquidity constraint. There's no money at all in the system. You won't believe it. We had to actually ask clients whether they had surplus cash which they could give to the bank, to the development bank, which we could on lend to customers. Interest rates were 16 to 18%, and inflation was raging. Capital market was dead. So you came back to India in the financial context, I think, full of pain. And other side, if you look at manufacturing India, industry, the industrial sector, even more pain, because the liberalization of 1990 was starting to bite. You could see competition. They realized that they were not at scale, they were not competitive in terms of cost, and they didn't have the quality required to really stand up. So the first 4 years were very painful, 96 to 2000, because you had a trajectory of increasing NPAs and all these problems around that I mentioned. So I think we had to work around this, which I'm sure we can talk of. And of course, the banks, the new private banks were fledgling. They were just starting. And at that point of time, if you really understand the commercial banks were mainly provided the working capital finance. They were not providing, capital, long-term capital for industrial growth and so on. So it's a very interesting milieu from where we were 25 years back to today.
Mr. Kamath, I was also talking to Mr. Narayan Murthy of Infosys, and he said the 1991 reforms in a way liberated Infosys because before that, for everything they had to take permissions. So, in a similar vein, how did the reforms liberate Indian banking?
If you look at the banking sector, we'll come back to the pain in the manufacturing and industrial sector, how that got resolved. But in the banking sector, I think the advent of technology, the advent of new banks meant that you now had a structure which could experiment. So, for example, ICICI Bank said that we will experiment with going into retail. And the retail became our focus at that point in time. And we drew a blueprint, as it were, for growth on the retail side and executed on that blueprint. And actually, since you mentioned Mr. Murthy was a part of that blueprint, and he still recollects how at the board we presented a blueprint really for going into retail in a large way, and how we executed thereafter. So I think if it was pre-liberalization, these degrees of freedom would not have been there to players in the banking sector. So if I were to quickly run 2-3 years into the, or 4-5 years into the banking sector, the internet, computerization, we called it computerization those days. You couldn't afford a mainframe, so you went on cheaper distributed processors, which became more and more powerful, ATMs, call centers, and in the space of 5 years, a bank where typically 100% of the transactions happened in a bank branch, you had a situation where less than 15% of the transactions happened in the bank branch, and the rest of it was, on I would say newer channels which came up. So, huge change in a very quick period of time. I would say in a span of 5 years on the financial sector front. At the same time, the capital market got momentum and so on. One last change there. working in a concerted manner, the Reserve Bank and the government, to the Ministry of Finance, brought down interest rates. And I think to the whole reform process and thereafter, this is a key element. And that what it did was it brought down interest rate from almost the government bond came down from 11.5% to 5.5%. A mortgage dropped from 14% to 7 or 7.5%. And all loans, car loans, motorcycle loans, industrial credit, everything dropped dramatically. I think that provided the momentum starting the year 2000. Side by side, the reforms and the pain that I talked about earlier in the manufacturing sector, the industry sector, through, again, well thought out restructuring, which was facilitated by the Reserve Bank at that point in time, we could clean up the banking, the manufacturing and the industrial sector in a large way. So you got, within 10 years of the reform process, you had a banking sector which was now able to lend properly, and I would say an industrial sector, a manufacturing sector, which was able to clean up whatever needed to be cleaned up, and then get on to a different path. And then in 2000, the government, opened up a whole lot of infrastructure effort, which actually provided the momentum for the next 10, 20 years.
Mr. Kamath, if you have to tell us about the next wave of reforms that will really galvanize India, what would they be? How can we take advantage of the inherent strengths that we have in the technology and internet economy? You have often spoken about how India is in a digital super cycle.
I think clearly the runway for India is at least another 25 years. For that, all you have to see is what happened in the Far East, that is Japan, thereafter the tiger economy, Southeast Asia, more recently China. The runway is very long, and I think we are just getting onto that runway. The 25 years is a given. Certain things have been already done and put in place, and I think we need to recognize that. We now have, a liquid situation in the country, and the Reserve Bank has taken a position that they will provide liquidity and keep it liquid for as long as it takes. And I think it will take a longer time than we think, because that's where the growth happens, with liquid conditions being conducive. Secondly, a conducive interest rate environment that also the Reserve Bank has indicated. And I think thirdly, we are coming to learn to live with low interest rates and maybe moderate inflation, and understand that it doesn't really harm us in that. Very high inflation, and then corrective measures might be required. But by and large, in our case, the correlation between interest rate and inflation, to me, is not very clear. So given that, one can afford to have moderate inflation and low interest rates. This provides a momentum. Indian industry is modernized. Just look at corporate India. 20 years back, at the start of the momentum, year 2000, corporate India was still leveraged 2.5, 2.8 is to 1. By 2010, they had brought down the leverage to 1.8 is to 1. Today, Chandra, if you look at the top 50 companies in the country, they have no borrowings at all, virtually. The next 50 have hardly 0.5 is to 1. I think everybody has learned the virtue of being debt-free. So you will have, I would say, a very strong, foundation for these companies to grow, given that they have cleared up their debt. This is one. Very interestingly, the last 1 year, the pandemic has also taught these companies to improve their process and cut costs. So their EBITDA margins have improved, their profitability has improved. So they are well geared. Everybody has talked of one challenge, that is simplification of, I would say, the approvals and the various other processes that are there. That, I think, is one area of reform the government is set on, and industry also would like to see. That's in the real sector. In the banking sector, I think at the moment, Reserve Bank has done whatever needs to be done and given full rein to players. And also allowing new players to come, because that also is important. We'll talk about that, not only in banking, but in financial services. And the third momentum driver, I will complete the older ones first. Agriculture is strong, modern, and reforms have been done. That brings us to the, I would say, the fourth driver, which you mentioned, the digital super cycle. And the digital super cycle, to me, has got an acceleration like never before because of the 1 year of pandemic adjustments that we did, starting in the payment space, starting in the broking space, and I'm sure learning to do things outside the office. The entire space has got an acceleration like never before. Now, there it is
Yeah.
not just the financial services business. It is a myriad type of enterprises that are coming up and driving momentum. I was watching just 2 days back a program where I heard some of the players in this business describe that last year there were 60,000 enterprises created in this space, and they created 165,000 or 170,000 jobs. I used to say in the year 2000 that every white collar job, say that an Infosys or a TCS or a Wipro creates 3 or 4 jobs. I'm sure the digital startups that are coming up today, the 160, 170,000 jobs they are creating, has got a multiplier effect, and they are creating another maybe 2 or 3 jobs. So you're talking of 500,000 jobs coming out of the digital super cycle, and we are not reckoning it. We still believe that there is more to happen there, and indeed. So I think that we will find in a very pleasant way that new things that are happening in our economy will be momentum providers as far as employment is concerned. And interestingly, has not happened anywhere before. Maybe in a small way in maybe China, but the wave in India, because we are open, we are large, we are young, is happening at great speed. And of course, finally, we have got very low cost data, the lowest in the world. So this is coming as a wave in terms of creation of opportunity and economic growth.
My final couple of questions to you, Mr. Kamath. Part A of this question is about fintechs. How are lending startups going to impact banks going forward? There is some regulatory arbitrage, but what impact will that have? And secondly, what is your reaction to the flurry of internet IPOs that we are seeing? It's really going to change the face of the market in wealth creation as we know it.
First one is something, this is a business I have been in. It is not going to be easy for a digitech firm or a fintech firm to be a lender and do it, because moving beyond payments, you're now getting into areas where you also need risk assessment. Yes, risk assessment is moving online. If you look at retail lending, that risk is now basically analyzed by people like the credit scoring companies and so on. Score is available and you can do it. Then again, secondary and tertiary ways to assess credit risk is clearly happening. People say, by knowing your attendance record, I know whether you are a good you're a good customer for me or no. Your attendance record at the place you work, and all your other data is today accessible. So it may appear to be easy for people to get in, but I would think this is an area regulated. So you will find it difficult for new startup companies or new players to actually scale up. Even if they scale up, getting funding is going to be a bit of a challenge. In the interim, it may happen in due course, but in the interim, I think incumbent players will reposition themselves because they have the regulatory, I would say, cover, as it were, and rightly so, because they are today custodians of public money. So you cannot have a free-for-all in that marketplace. There has to be order in that market, and that's what I think the regulators will, all over the world, are doing. So new players will be allowed, but in a measured way. In the meantime, I expect a lot of the existing incumbents to reinvent themselves. I think it's not too late at all, and they can very well reinvent themselves. They will have to do some hard work. The platforms may have to change. The way they look at themselves may have to change. But they have been in this business for long. They have the resources, they have the strength, and they should be able to do these changes as we go along. And as I said earlier, making money in India is not easy. The payment companies are quickly realizing that money there, they're still trying to figure out where is the money. So that's going to be a challenge in India for almost all digital players, because competition is severe. There is a crab mentality, and you tend to drive. That brings us to the new players. Ultimately, I'm a little bit of the old world. There are several of us, I think, around, who say that good, these are all technologically brilliant ideas. I fully endorse it. But the value proposition in this idea is in terms of making money, making profit, and ultimately shareholder value through that has to be demonstrated. And only then will you see true gains in the capital market. Otherwise, it could be short lived. So I wish them well, and I hope that all of them get to a revenue model which is sustainable revenue, sustainable profit, which then you apply whatever multiple you want. I'm happy with that based on growth expectations, because that's the classic old theory in terms of how you look at value. And as one of the pundits I read just yesterday said, ultimately it's a discounting exercise. You discount your future streams and see what is your value today. And of course, maybe you allow for growth and so on in that multiple. You may make some exceptions, but you cannot have a situation where you are not making money and expecting value and continual increase in values in the market. I'm sure these will be very quickly mastered by these players, because at the core, I think a lot of them have built brilliant businesses. And I wish all of them success, but in a way, success riding on profit.
On that note, Mr. Kamath, thank you very much for talking to Money Control and for articulating so well how there is a groundswell and perhaps we haven't even reckoned it yet. It's not being counted as growth in India. On that note, thank you very much for joining us. Stay safe and take care.
Thank you, Chandra. Keep well, keep safe.